A real pleasure for me to once again catch up with Marc Faber, editor and publisher of the Gloom, Boom and Doom report. He joins us from Switzerland. Marc, great to have you back on the programme. Now, the British government has just announced part 2 of its bailout plan for the British banking sector. Again, we've got a combination of efforts to put government money into the banks through taking equity stakes. We've also got an insurance programme here to backstop the current portfolios of toxic debts. No outright nationalisation as such. Very much following the American model. Do you think this is going to get institutions lending again, Marc?
Well, I think that the credit markets have improved somewhat. Bond issues are flowing again and spreads have narrowed somewhat. But we have to be aware that there is a danger that one day government credit, in other words, government bonds, will be downgraded because obviously the ability of governments to meet all its obligations is worsening at the present time. And I think that may be the shoe to drop sometimes in 2009 or next year when the government bond markets weaken.
This apparent improvement in corporate credit markets, Marc, has been interesting. Nomura, in their weekly note, suggests that that this, along with the pace of analysts' earnings cuts stabilising, suggests that one can comfortably begin to be a value investor and start looking at some of the opportunities both in the credit and in the equity markets. Is it too early?
Well, I would say if you look at an ETF of investment-grade bonds in the United States, LQD, it dropped in October to 75 and it's back up to over 100 at the present time. So we had already a big rally in corporate bonds. And also we have to be aware from the lows on November 21st, the equity markets has on the S&P rallied from 741 to a high on January 6 of 943. In other words, we were up 27% and now we're correcting this again. In general, I think that the markets may still rally somewhat more. But there has already been an improvement. There has already been a rally in the credit markets, in the stock market and so forth. And the economic conditions, everybody expects the second half of 2009 to improve. I think there's a very good chance that the second half of 2009 will be even worse than the first half of 2009. So eventually stocks could still come under pressure. Don't forget the S&P 500 was earning on an annualized basis in the third quarter $45. It's going to decline to around $40. So at 850, 900, the S&P is not particularly inexpensive.
Marc, what is the criteria for searching for value at this point? I mean, I was reading through your December note. Do asset markets really provide lifetime buying opportunities? You'll know there is a school of thought out there that argues that the November low is probably the low, and ultimately we may go sideways or wiggle downwards. But if you bought then and you hang on for 3, 4, 5 years, you will actually make reasonable money here.
Well, I mean, that is a hope. If you look at Japan, we're in Japan at the same level we were in 1981. So basically, if you bought the Japanese market in the 1990s, you're still waiting to make any money. And as I explained in my recent report, if you really believe in value, there are some markets that are at the level they were, as I said, in the case of Japan, 81. In the case of South Korea, Taiwan, they are at the level they were in 1987. So essentially 20 years later, these markets are no higher than they were at that time. So if you look for value, I think that in Asia we can find some pockets of value. Secondly, in Asia we have dividend yields that are frequently 3 times to 4 times as high as the bond yield. Now, I have no doubt that dividends will be cut. But even so, I think that many dividends will be higher than the bond yield, so at least you're paid to wait. Also, if you talk about oversold markets and major lows, I mean, commodities have been hit very, very hard since July, when the CRB peaked out at 473. We're down for many commodities by 70–80%. And unlike equities that were in an essentially bull market since 1982, commodities have only started their bull market in 2001, so we're relatively early in a rise. And I think because of the credit crisis and because of the low prices for commodities, exploration will come to a stand, and not much new oil supplies will come on stream, and not much new mining supplies will come on stream. So whenever the global economy recovers, and I hope it's in our lifetime, then obviously commodities will again rise very substantially, and you could pick up now some quality names in the commodity sector that then should perform very well.
Ultimately, it's a question then of this liquidity returning to the asset markets. And, you know, one of our earlier guests was already talking about his concern that we have inflation in the pipeline. We were all kind of nodding, but saying, OK, well, let's deal with the deflation or the disinflation that we've got to address first. Do you see, as one of our previous guests, Alan Duncan, did, inflation being closer around the corner than we're all anticipating at this point?
Well, I think the Federal Reserve and other central banks have introduced a very high level of volatility into markets, into asset markets, and also into economic activity. And if you look back at the last few years, investors were always kind of caught between believing in deflation and believing in inflation. At the present time, there's a widespread belief that deflation will continue. And that's why US government bonds, the 30-year, sells for at the yield of less than 3%. I'm asking myself, who in his right mind would buy a 30-year US government bond in a structurally weak currency with a yield of less than 3%? And for sure, in the next 30 years, there will be a time when these government bonds are a horrible investment. So my view is actually that, yes, at the present time we have deflationary pressures, although I have to say, whenever I go and buy something, it's always more expensive. Now, maybe you say, oh, Mark, he doesn't know where to shop. But whatever I buy is always more expensive, and other people tell me there is deflation. There's been deflation in asset markets, but I haven't noticed it in consumer prices.